Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to my weekly show here on Stockcharts TV. It's a shortened holiday week here for Thanksgiving, the Thanksgiving holiday here in the U.S. I hope you have lots to be thankful for. Personally, I am thankful for all of you joining me here on Stockcharts TV, watching all the content we put out on Stockcharts TV, using the Stockcharts platform, asking great questions, makes it pretty entertaining to be navigating these markets with all of you. Markets had a choppy week last week, and as we go into this, the last trading week in November, again, granted a shortened holiday week, we're seeing a nice bounce here on Monday, November 24th, from growth leadership, from the Mag 7 stocks, charts like Alphabet, Broadcom, and other semiconductors like Micron, AMD, Applied Materials, having strong upswings today. And that's after showing quite a bit of weakness through the course of last week, through Nvidia's earnings report. So while it's easy, I think, to think of the Magnificent Seven stocks as one group where all the charts are the same, what you will find is as we look at all of the names in what I call the Magnificent Seven and Friends, there's actually quite a bit of dispersion, right? Quite a bit of differentiation between the charts that are really working and the charts that are clearly not. And I think what technical analysis can do, it is a great myth buster, right? It's easy for us to think of the Magnificent Seven as this group of stocks that are just kind of doing this. And, you know, at times over the last couple of years, that's exactly what's happened. They have been one homogenous group. Maybe Tesla's an outlier, but the rest all look the same. This is not one of those times. So I'm going to separate the Magnificent Seven stocks into four different buckets. We'll talk about how the technical configurations are actually quite different, and some of the things I think you should keep in mind when trading or analyzing each of those four different buckets, because I think your approach arguably should be very different for each of those buckets. Before we get to those leading growth names, those charts and their implications, do want to remind you, if you're looking for my daily market recap show called Chart This with Dave Keller, it's on my YouTube channel called Market Misbehavior. Check that out. We put out a video every trading day after the close, recapping key movements in the market, looking at the heat map, which is a way of analyzing market conditions at a high level down to a very specific level. And then we'll look at charts, take some questions at the end of the week as well. Also, the Market Misbehavior podcast. I sat down recently with Alan Ellman. We talked about a cash secured put, which is an options trade that you may not be familiar with. But I had a great discussion with Alan, a little larger, about options trading, about how to get started, some of the defensive plays you can make in a period of market uncertainty. I think it was a super timely conversation. You can find that podcast, that episode, and many others on my YouTube channel as well. So I hope you can check those out. All right, so looking at the chart of the S&P 500 to start here, you know, when I think about a market showing vulnerability, which certainly in the last 4 weeks we have seen that, right? The chart of the S&P 500, at least in the short term, making a short-term pattern of lower highs and lower lows. The S&P over the last week has gone below its 50-day moving average for the first time since April. So we've had quite a bit of a shift from the long and strong classic uptrend phase that we observed really since the end of June fairly consistently with what we're now experiencing in November. But you may have noticed, because I've certainly been following, that the S&P has really not made a new major low, meaning it's not really undercut its most significant previous swing lows, which I would say is around S&P 6550. That was the low in late September. You can see we retested that in mid-October. We're now right back to that point. Thursday, which was that big down day where we closed well below the 50-day moving average, that was after Nvidia's earnings on Wednesday, which are actually pretty good, but the market opened higher than closed a lot lower on Thursday. Friday, we bounced right off of that 65.50, and today, on Monday the 24th, so far, we're actually continuing higher, trading right back up to the 50-day moving average as we record this video. So I think still very much an open question, right? At best, I think this market is in a consolidation, right? So we can tell that the pace of the uptrend has slowed, because this was the channel that we were looking at, certainly on in a lot of my content. And now in the last 2 months, we can see that October, November has really sort of tapped the brakes on that uptrend, and now we're in more of a sideways consolidation phase. And the way that you exit a sideways consolidation phase is one of two ways. Either we break down, and this ends up not just being a sideways consolidation, but a topping pattern, and we know that that's true if the S&P, or if whatever chart you're looking at, breaks below that major line in the sand. So I would say S&P below 6550, broken market, broken chart, time to think much more defensively. But we can also exit consolidation phase to the upside, right? Maybe this is a pause in the trend, right? The market just hits a pause button. We're in an equilibrium. Buyers and sellers are in agreement. And then a new catalyst pushes the S&P to new swing highs. What I like to do there is draw a simple trend line using the major high at the peak, which was that high around 6,900 in late October. Connect that to the next major high, this lower peak that we had second week in November. We break above like S&P 6,800. I would argue that's resolving that pattern to the upside, and that the uptrend phase we observed in Q3 is most likely resuming. Right now, we're in that no man's land between the two. I think it's still an open question, although we've seen plenty of signs of distribution in terms of breadth and momentum and volume turning lower. But the S&P for now is holding its line in the sand. So with breadth conditions weakening, with momentum conditions clearly negative, with volume looking a lot less positive, why isn't the S&P and the Nasdaq, why aren't they down a lot more? And the answer is because of the Magnificent Seven stocks, right? These are the big mega cap names that are such a huge weight in the index. Here's a chart of MAGS, which is an ETF that tracks the Magnificent Seven kind of bucket of stocks. It's not perfect, but I think it's a good proxy for that space. If you look at the chart of MAGS, you'll find it looks almost identical to the chart of the QQQ, which, to be honest, looks almost exactly like the chart of the S&P 500, because they are all driven by this same basket of stocks, right? When you look at the QQQ to the SPY, you're just adding a bunch of other things, but the biggest weights are still those same, big heavyweight growth stocks. So the MAGS ETF has, similar to the S&P, broken below its 50-day, similar to the S&P, testing its 50-day from below here on Monday, similar to the S&P, testing its own line in the sand around $63. And I think very similar, if we would break down, I think that would indicate a real distribution phase, the likes of which we haven't seen since February and March of this year. So with that in mind, let's talk about how, while the Magnificent Seven as a group has a certain look, right? That ETF that sort of combines all of those prices sort of looks like very similar to the S&P. But when we look underneath the hood, when we look at the components of that basket of stocks, you'll find that there's actually quite a bit of differentiation. From Alphabet, with a remarkably strong chart, making new all-time highs again today, to Netflix making new 3-month lows this week again, after being in a pretty consistent downtrend here for a number of weeks. So there's quite a spread from the winners to the laggards here within this basket of mega cap growth stocks. So we're going to talk about 4 particular buckets. First off, the strong charts. And I would say there are 3 that are clearly differentiating themselves as being remarkably strong. And coincidentally, all 3 of these are the ones that currently sit above their 50-day moving average. So only 3 of the 9 stocks I'm about to show you are above their 50-day moving average. I think right there, that's telling in the fact that most of them are actually below their 50-day, of course. But Alphabet, by any definition, is in a clear classic uptrend. This is what the chart of the S&P and the Nasdaq looked like back in like July and August, right? Higher highs, higher lows, prices making new 3-month highs consistently, prices above upward sloping moving averages. The momentum is in a clear, strong position. In the chart of Alphabet, we're seeing consistent outperformance because because the chart is doing so well, while the S&P is sort of sideways and holding steady. So how should we think about the charts like Alphabet? To be honest with you, these are the long and strong, up and to the right, innocent until proven guilty types of charts. What stands out on the chart of Alphabet is that it is in a clear uptrend phase. We've had pullbacks all along the way, but they've all found support right around the 21-day EMA. It's actually quite unusual with this group of stocks right now. Very few of them have looked as strong, as consistently strong as Alphabet. That's why I would argue it is by far the strongest chart of this bunch. This is the type of chart I assume that the uptrend is going to continue. Innocent until proven guilty. I'm going to assume that trend is going to persist until there's some overwhelming evidence otherwise, and I'm not seeing any of that. Even more recently, we saw a potential divergence with Alphabet sort of holding steady a little bit while the momentum was trending downwards. But just in the last couple sessions, we've seen a resumption of the uptrend as Alphabet's pushed above $300 a share this week, and we're seeing the momentum resume its uptrend. So overall, I would say strong chart getting stronger. The next two charts, I still put in this leading bucket. These are the other two charts that are still pretty consistently strong. Apple also has had a number of pullbacks to its 21-day EMA, but we can see most recently Apple's been a little more sideways. We made a new high around 275, 280 here at the end of October. We've now had a couple retests of that resistance level. We've not quite broken out, but very, very close to doing so here today on Monday, November 24th. But again, similar to Alphabet, we're above the upward sloping moving averages. The momentum is strong, but not excessive. The relative strength is good. So again, another chart innocent until proven guilty, I would say. Broadcom is another one similar to Apple. I would say still overall in an uptrend. The reason why I added this to this top bucket is because just today, after Friday closing below the 50-day moving average, here on Monday closing back above it, still I think would be ideal if it could break above that October swing high around 390. But I'm inclined to give a chart like this the benefit of the doubt as it gets back above moving average resistance, as the momentum overall has been in a strong range with the RSI holding consistently above 40 since the April low. So I would say, again, a chart like this is pretty good. So how do we think about these names? So with this type of chart, innocent until proven guilty, when I say something like that, that means be a trend follower, right? You follow the trend. You assume the trend is going to persist. Keep bumping your stop up, whether that is an automated stop, like an average true range type of stop that's automatically drifting higher, or if you're manually moving it higher every time the chart makes a higher low. In either case, assume that trend persists. Wait for the chart to tell you it's no longer in an uptrend. With all of those charts, I would say the uptrend is still safely in place. All right, second bucket of stocks are names that have pulled back a little bit. They're not at their all-time highs. Both of these stocks are actually below their 50-day moving average. And so to get to the punchline, what are we looking for here? For me, a break back above the 50-day. That's why Broadcom, which was sort of in this bucket as of Friday, just this morning I looked and I said, all right, we're back above the 50-day. I think that's a good chart again. I think that's a great way to use something like the 50-day moving average in this sort of environment. Great way to look at stocks that are pulling back, which ones are starting to recover enough that we're seeing enough signs of accumulation that maybe we can assume that the uptrend is resuming. I think getting back above the 50-day is a great kind of simple way of differentiating and figuring out the strongest within a group of stocks that are in a pullback phase. So these next two have not yet gotten above their 50-day. That's exactly what I'd be looking for. Here on the chart of Nvidia, what's so important about what we just learned last week, Nvidia had rock star good earnings. I mean, exceptionally strong earnings on Wednesday after the close. Wednesday after hours, the stock was trading higher. Thursday morning, the stock gapped up and opened around 196, and that opening price was the high for the day. From there, the stock sold off and closed near the lows of the day. And going into last weekend, we saw that, and I think we still think of that as a big sign of distribution, right? When great companies report great earnings and that gap higher is sold, that tells you there's not a lot of risk being added to the market. Not a lot of investors looking to add a lot of risk. Are getting a little more nervous and they're excited to cash out as the stock gaps higher. So Nvidia, despite really strong earnings last week, has stalled out and remains in this consolidation phase. For me, getting back above the 50-day would be key. On the downside, if we would break below 164, that would take us below the first Fibonacci support level, also the early September low. And I think if that would happen, that would be a very bad sign for the S&P and the Nasdaq because of Nvidia's strong weight to our $4 trillion market cap. Tesla's another one, right? Has traded lower, actually did break below its major lows in October, undercut the 50-day moving average and remains below there. So I'm concerned with a chart like Tesla that it is unable to get back above the 50-day moving average. Over the last week and a half, it's really been consolidating, so we wait and see what happens. But for me, this is the kind of chart that until we can get back above the 50-day, there's just not enough signs of accumulation in my book to justify getting into a chart like that versus others where you are seeing those signs of accumulation. So similar to the chart of Nvidia, I think for Tesla, getting above 435, which would clear the 50-day moving average, I think would be a strong vote of confidence. Follow through above 470 would really be the all clear we're looking for. I like the fact that the RSI has held 40 though. That's an encouraging sign. And if we would break down any further than what we saw on Friday, the 200-day moving average is looming large around 340, and that actually lines up really well with the consolidation that we saw over the summer on the chart of Tesla. So there's your second bucket, two stocks, Nvidia and Tesla, that have broken below the 50-day. I'm looking for a break back above the 50-day as a signal that maybe things aren't as bad as they've been. All right, next two charts, actively testing the 200-day moving average. Both Microsoft and Amazon have broken well below their 50-day moving average and now are testing kind of the level, the 200-day moving average. Paul Tudor Jones famously said, nothing good happens below the 200-day moving average. And for charts like this, holding that 200-day, I would say, is pretty key. Microsoft is a $3.5 trillion market cap, obviously one of the biggest listings here in the U.S., and as a result, stocks like this breaking their 200-day can really weigh on the S&P and the Nasdaq. And if you're wondering why, with Alphabet looking as strong as it is, why is the Nasdaq not making new highs? That's because charts like Microsoft are also in that same bucket, and it's actually been breaking down here. So all is not well in the Magnificent Seven. The second half of the video, you're going to see some of the charts that actually look, I would argue, quite vulnerable. So chart of Microsoft and the chart of Amazon, the question for this week and into next week, can it hold the 200-day? If so, that could be a great secondary entry point, maybe a bit of a bounce if I'm a swing trader. Maybe I'm looking for a short-term bounce off of that level. RSI is oversold as we test the 200-day moving average. That's usually a pretty decent opportunity for a bit of a counter trend bounce. But watch after that bounce, the next leg lower is what can be really painful. So if we make a lower high and then accelerate below the 200-day, charts like this don't hold the 200-day, that's when selling can accelerate, because once investors realize that long-term barometer is not going to hold, no one wants to ride it all the way down to like 350. And so you cash out immediately on the break of the 200-day. So crucial pivotal moment for Microsoft on the 200-day moving average. And I would say for Amazon, the exact same thing. Thursday of last week, we actually traded down toward the 50-day. Friday session traded on an intraday basis exactly down to the 200-day moving average, which is very much in line with the October swing lows. We're bouncing higher here today, which is encouraging, but I would say similar to the chart in Microsoft, a counter trend bounce off the 200-day makes a ton of sense. If we would break below the 200-day moving average, which would mean below 215 on Amazon. What's interesting about the chart of Amazon, you actually have a cluster of support. We have this swing low from mid-October around 211. We have the first Fibonacci support level around 207. So getting below that sort of confluence of support would be a very negative sign for Amazon. What would be good? Similar to the previous charts, getting back above the 50-day is always a really good starting point. That's a really good signal that, okay, things aren't that bad anymore. We're starting to see some signs of accumulation. Maybe we want to reassess. But I think for Microsoft and Amazon, the question for this week, can it hold the 200-day moving average? And if not, those are the types of charts I tend to avoid until proven otherwise. All right, now we're to the worst bucket, right? The least strong bucket. These last two charts have already broken below their 200-day moving average and really haven't looked back. Meta is, I would argue, by far the worst chart of this bucket, of this basket of names, because we had the gap lower on earnings at the end of October, and then it's just been a consistent downtrend since then. We broke up. We actually gapped below the 200-day and below the first Fibonacci support level, and then we just kept going. We did bounce off of the 61.8% retracement. Had this great hammer candle a couple weeks ago, but it really didn't turn into much of a bounce. And then last week, we spent most of the week below 600, which is below that last Fibonacci support level. With charts like this that are in clear downtrends, and I think for Netflix it's the same thing, you're looking for signs of accumulation. You're looking for buy signals. You're looking for trend indicators that are going to be clearly negative starting to turn higher. So things I would be looking for: a bullish divergence with RSI. We really haven't seen that yet. We are seeing a bounce today, and we're seeing the RSI pull out of that oversold region, but no real divergence as it was making new lows. We really didn't see an improvement in momentum that would make me more optimistic. The MACD or PPO indicators can be great ways of identifying a buyable turn, right? If you're more of a swing trader, the daily MACD or PPO can be a really good way of identifying maybe a buyable dip, a swing, as a bit of a mean reversion trade. We might be getting that on the chart of Meta this week. But for now, again, still making lower lows and lower highs. Netflix, same issue. While Meta has broken below the 61.8% retracement of the range set earlier this year, Netflix is still holding it. And I think for the chart of Netflix, the question is, does it hold 102? 102 is that Fibonacci support level. You can see we bounced off the 38.2% retracement level a number of times. We then broke down and that level became resistance. Now we're down to the last support level. So if 102 doesn't hold, this is a chart that could potentially get much worse. But notice here as well, similar to Meta, the momentum compared to Alphabet, where the whole range of the RSI is very high. Here with Netflix, we have the momentum clearly in a bearish phase. This is a chart in a confirmed downtrend. So what you're looking for, again, signs that that downtrend is no longer in place. So a bullish divergence. If we would get a bounce here on Netflix on higher RSI, that could be an encouraging sign. Again, indicators like MACD and PPO can be great for an upside reversal. The last thing I would say was something like Netflix or Meta. If you're a longer term investor, use the weekly chart, right? So here's the weekly chart of Meta, and I'm looking at the weekly PPO indicator. Anytime you have something that's in a downtrend that lasts for more than a couple weeks, right? So Meta, like back here in February, March, into the April low, and a lot of charts obviously had that distribution. I immediately switched to the weekly charts because if the weekly PPO can generate a buy signal, which happened here in mid-May, that's like you're all clear, right? If that happens, that tells you, all right, the bottom is now behind you, and if you've been avoiding it, this is where you can't avoid the uptrend anymore. So if you're a little more conservative, a little more skeptical, the weekly charts waiting for more of a weekly reversal could be a little more conservative. You'll miss the beginning of the move, but you won't get whipsawed as much on any sort of counter trend rally. So something to think about for those charts as well. So that's it. That's how the Magnificent Seven group of stocks, and I sort of added a couple to make it a 9 list of stocks. What's interesting about these names is even though the S&P, the Nasdaq 100 have very similar charts with both testing key support levels this week, the charts of the Magnificent Seven range quite a bit from clear uptrends like Alphabet to clear downtrends like Meta. I think the real value in technical analysis is in differentiating a group of stocks, right? Don't think of the Magnificent Seven as one bucket of names. Think of them as how we described here, 4 different buckets with very different patterns, very different approaches, and different technical indicators and techniques you can use to identify optimal entry and exit points in each of those different buckets. Which of these 9 names do you think presents the greatest opportunity between now and year end? Take a moment, drop a comment, and let me know. I'd love to know which names stand out as you're reviewing the strong to the weak and everything in between. As a reminder, I'm so glad you watched the show here on Stockcharts TV. I do a show every week here on the Stockcharts TV YouTube channel, but I'm on my own channel called Market Misbehavior with Dave Keller every day, often multiple times. We do a market recap show called Chart This with Dave Keller every trading day after the close. I also do a market misbehavior podcast where I sit down with top market practitioners and ask them questions to dig into their mindset and their routines and their outlook. I hope you can check out my content over there. In the meantime, have a wonderful, happy, and joyful Thanksgiving holiday. Wish you a restful and happy week. And I am thankful you will be back joining us in the month of December and beyond. For Market Misbehavior, I'm Dave Keller, reminding you it's always a good time to own good charts.